Today, I'm very excited to once again have my guest, Larry Swedroe. Larry's the Director of Research at Buckingham Wealth Partners, Buckingham Wealth, and the author of, we just counted 18, going on 19 books about finance and investing and economics. And I'm thrilled to have Larry here today. Our topic is inflation, among other things. And certainly it's in the news. Larry, I think we saw something come out a couple of weeks ago that told us that inflation is running at 5.4%. I'm not sure exactly what that means, but maybe you can help us a little bit during the course of our conversation today. What I know is that our clients and investors hear a lot in the news about inflation. So I wanted to spend a few minutes with you today and start by taking a step back and let's go through some basic definitions to really get a sense of why should investors even care about inflation. So help us out and can you help us with a basic definition of inflation? What is inflation?
Yeah, sure. Well, inflation is an increase in the cost of goods in real terms. So if your salary is, say, $100 a week and you spend a basket of goods and that basket costs you $100, that's your baseline in year one. If your salary remains unchanged and that basket of goods costs you $105, well, your inflation rate is 5%. Now, one of the tricky things for people is that everybody's inflation rate is somewhat different because we spend on different things. And for example, healthcare costs have been rising much faster than other costs because it's harder to get productivity in those things than there is, say, in building a computer, where we know you can buy a computer today for about $300 that would have cost, I don't know, $3,000 10 years ago, right?
Yeah.
The TV, you can now buy 40-inch 5 HD for $300, right? You know, I was buying 26-inch TVs, for 30 years ago for $2,500.
Right.
So their inflation really depends upon your own basket. So we can touch a little bit on that to be helpful for your audience.
Sure.
So there is what's called the CPI, the general number that they refer to. That's an adjusted basket. It's what's called a chain-weighted number. And what they do is they look at where you spend your average dollars. So what that means, if you used to buy, say, 5 pounds of steak and 5 pounds of chicken each week, but now steak costs double and chicken costs don't, and a lot of people may shift more to chicken, so they'll change the weights. Because that's the way you're spending the money. Some people would argue that's not exactly measuring inflation properly, right? And the inflation rate, as I touched on earlier, can be quite a bit different, especially for seniors, where medical costs are rising faster, but they don't impact young people as much. So they have all kinds of measures. There's a city measure. There's a urban, non-urban measure. The one we see is for the whole country. And it's also important because it does impact Social Security and a lot of other contracts that are tied to inflation as well. Inflation doesn't hurt you if your wages are going up as much, if your assets are going up as much. But it can hurt you if your asset values and your wages are not keeping up with inflation. And one last thing, inflation actually helps some people. Those people who have fixed rate debts, they get deflated, they get paid back in cheaper dollars. So that's depends upon which side of the asset liability mix you're on. But inflation can be a risk for a lot of people, especially those on fixed incomes.
It's such a good point, Larry. I really appreciate the fact that you differentiated and helped us to understand that inflation can impact us differently depending on what we're buying and what we're actually spending our money on. Often when we've talked to clients about inflation from a planning perspective, we talk about it in terms of general purchasing power. And we think about how much a dollar will buy based on different rates of inflation. And we know historically when we use a 2 or a 3% inflation rate, in general, what we're trying to help our clients understand that over the course of a 30-year retirement, if that's how long they're going to be retired, that at those rates, they really need to think about their money, the purchasing power of their dollars almost doubling over that period of time. We know that at a 2% inflation rate in 10 years, a dollar is really going to have about 80 or 82 cents of purchasing power. And at a 6% rate of inflation over 10 years, a dollar is only going to buy about 50 or 55, 56 cents worth of purchasing power. So different ways of looking at it. And you're right, and everybody's individual case is a little bit different depending on what they actually have to use their dollars to buy.
Yeah, Michael, so you think about it, most younger people, maybe they're married, have a couple of young kids, they're working, their labor capital, their wages tend to keep up with inflation for the average person.
Right.
They often will have a fixed rate mortgage on their home. So inflation can help them. It certainly doesn't tend to hurt them so much. On the other hand, you get retirees and inflation is going up. And if, their Social Security goes up, but maybe it doesn't go up as much as their inflation because medical costs are rising even faster.
Yes.
And they have a lot of fixed rate bonds in their portfolio because they're trying to take less risk with their financial assets as they age. That could be a real problem. So you have to design a portfolio that really can hedge those risks or at least minimize the risk of inflation getting at excessive levels where it really can hurt you.
It's true. And again, when we're going about planning with our clients, classically, we simply lay it out very simply that we need to make sure that your dollars are keeping ahead of inflation and ahead of taxes. And at that point, we're on the positive. If we can stay within the positive side of those two things, then we're doing okay.
Yeah, Michael, that's a really important point. Sadly, politicians often use inflation as a way to tax and raise revenue because they don't adjust the tax brackets, but the spending goes up. And so they need to generate revenue. So they hide it by, we didn't raise tax rates, but in effect they did because you get pushed into higher and higher tax brackets. So that's an insidious way for politicians to create tax, and that becomes difficult for investors. It also tends to be very regressive. So inflation really hurts the poorest people because if you're generating, let's say you got a $10 million portfolio and you're spending $400,000 a year and inflation goes up, if you have to cut back a little bit, you're going to be fine. But someone who's just getting by and inflation picks up and their cost of food and their rent and they can't generate any more income, they're in a bind and they can really be hurt because they have no way to catch. So inflation is really a tax on the poorer people as well. And that's a real problem because it tends to very quickly drive up rents and food and costs, and they don't have things they can cut back on expenses. You and I might be able to skip a trip to Europe this year or delay buying a car for a year. We can get by, but a lot of people, especially seniors living off Social Security, not much else, maybe that could be a real problem.
It's true. It's true. And I want to remind our attendees today Larry, to send us any questions. We're going to be taking questions throughout the session today. If you'll just enter them in the chat box down at the bottom of your screen, we'll address questions as they come along, and we'll leave some time at the end for questions too. Along the same lines, Larry, I know in the headlines, sometimes lately over the past couple of months, we've seen a few other terms that maybe you can help us define. And one of those is a scary one, which is it kind of takes the inflation to the next level, and they call it hyperinflation. What does that mean, and what are they referring to when we see people referring to hyperinflation? What's that all about?
All right. So historically, the average rate of inflation in the US has been about 3%. Okay. So we generally talk about that's the history over the last 90 years. I think if you go back further, inflation averaged even less than that. In fact, through much of the 1800s, we had periods, long ones, of deflation where prices actually fell, often during severe recessions. We had that. When you get lower inflation than that, and when you get below zero, that can be a real problem. Deflation is a threat because when people expect prices to fall, they're more likely to delay spending because they could buy it cheaper next year.
Sure.
And then you could get a vicious circle of lower inflation, lower economic growth, unemployment, and then people worry more deflation. I'll wait, I better save. I'm more worried about my job. They spend less. And even what tends to happen in the Great Depression, people who have wealth and can afford to spend become concerned about what you might call conspicuous consumption, and they don't spend. They actually pull back. That was one of the things that exacerbated the Great Depression. And President Roosevelt was actually extorting the wealthy, go spend your money, but they were afraid for social unrest reasons to have conspicuous consumption. So deflation is a really big threat. Inflation 2 or 3% can be handled, doesn't tend to distort things too much. When you start to get much above there, then inflation can really erode purchasing power. It's very regressive, as we talked about, and the Federal Reserve is concerned about it getting out of hand, because the other side of that is if people expect inflation to be higher, well, they do the opposite of when they think deflation. Hey, I better run out and spend more, driving prices even higher. And you end up with Weimar Germany. Those who don't know the story, people will get their paycheck, run home, right to the bank to cash it, because 2 hours later it was worth less. People were pushing wheelbarrows of money to buy a loaf of bread. Inflation got hyper, and that's what we've seen cases in places like Argentina, Brazil. Basically, currencies become worthless. And in Germany, for example, they declared a new mark and wiped out the last, 9 zeros. That's real a risk, and that creates great social danger. You typically end up with dictatorships, wars, really bad stuff because of the consequence. So the Fed is, I'll give you my thoughts briefly here and how to think about, because our clients, many investors are very worried about inflation and the risks of it. And that can cause them to make bad decisions like, well, interest rates are so low, I'm worried about inflation, I'm going to just sit very short term. And I've heard that for 10 years, and you've earned nothing, losing about 2.5% a year on your money, when if you just kept it in CDs or munis, you at least were getting some higher rate of return. And I know people have been sitting on cash recently, the last year or so, and that becomes a problem. So there are number one rule to learn about forecasting, and I'm a trained economist. I worked at Citicorp and sold economic forecasts. And what I have learned is that research shows there are no good forecasters. The best forecast is to look at the market's forecast It isn't great, but it's the best forecast we have.
Mhm.
And so your listeners can look at the market forecast of inflation in one of two ways. I'll give them to look at it. One, you can go to a website, Bloomberg.com,
Mhm.
and they have us on their website, a site called Treasury Yields. And it shows, for example, right now, I'm looking at the site is Bloomberg.com, markets, rates, and bonds.
Mhm.
And then you look at US government, and the 10-year is now 1.3%.
Yep.
Now we can then look at the 10-year inflation protected securities market, which pays you a real rate and then adds in whatever inflation is. Okay. So if the
Mhm.
real rate was, for argument's sake, 0 and inflation was up 5%, you'd get paid that 5%
Yep.
on top of that. Today, that 10-year rate is minus 1%.
Ouch.
So if you want to guarantee no risk of inflation, that's the only sure way to do it. And
Yep.
it doesn't even protect you against your inflation rate. Protects you against the CPI rate, which may be lower or higher than yours.
Yep.
But at least a reasonable estimate then by the market, which I think is as good a forecast as we have, is they're not worried about inflation.
Right.
Because we could take the 1.3, subtract a minus 1, so you get roughly 2.3 expected inflation for
Mhm.
the next 10 years.
Yep.
Now that's a bit of a misstatement because it doesn't include a risk premium for unexpected inflation. So people are willing to accept a little bit lower yield on tips to get rid of the risk that inflation is worse than expected.
Yeah.
We don't know exactly how to measure that. It's impossible. There's no way to do it. But you might say it's 25, 30 basis points today. If inflation was much higher, like in the 70s, maybe people are willing to pay 50 or even 100 basis points to get rid of the risk. So I like to use a second measure because that one is a little noisy because we don't know what this insurance premium is,
Mhm.
but that first measure gave us 2.3%. The second measure, you can go to a website from the Philadelphia Federal Reserve of Philadelphia. They have a website and they have a consensus forecast they call, it's the professional forecasters. Let me see if I could find that on my computer quickly. It's called the Survey of Professional Forecasters by the Philly Fed, and their current forecast, the second quarter for inflation, let's see if we can get that. And so they survey, I think it is the top 60 or so bankers, they're
Mhm.
economists. So you could think of it as a consensus of some of the top people, and they influence inflation expectations, right? Because they're putting out a forecast. That current 10-year forecast calls for about 2.3%. Oh, let's see, hold on, wait, that's the GDP. Here we go. 2.3% happens to be exactly
There
the
we go.
same.
Yeah.
Right. Now, here's what I think is important for investors to think about. The wrong way to think about inflation is they think about it, okay, it's going to be 2.3%.
Mhm.
We don't know what it's going to be, and we have to build a financial plan that could sustain a vast dispersion of possible outcomes. Because
Yes.
we could end up looking like Japan because of these massive budget deficits now proposed by the Biden administration and built up by Bush, Obama, and Trump. So both parties are both guilty.
Mhm.
But Japan, because of their massive debt, has actually had no inflation or deflation for 30 years and no economic growth, partly because of that. GDP debt ratio, they're over 250%. That's a drag on growth. The Biden administration, in my opinion, is playing with fire, and the Fed is enabling it, I think it's a big mistake. I
Mhm.
think one possible outcome to think of is that we end up looking like Japan with very low economic growth and maybe even deflation. That's possible.
Yep.
Second scenario is the Federal Reserve gets it dead right. We don't have these problems. Everything works out, almost like fairyland, but it does work out. And we end up with 2% or 3% growth and 2 or 3% inflation. And so that's scenario B. And the third scenario is the Fed gets it wrong and they can't tame inflation. They underestimate the risk. We turn into the 70s, and now there's tremendous political pressure because if you tighten interest rates, slow the economy, that puts us into a severe recession, which would blow up the budget deficit even more, hurt the poorest people. And here's the last problem that no one's really talking about.
Mhm.
If you think about the long-term interest rates in the US, the real rate on treasury bills has averaged 50 basis points or so, just rounding.
Yep.
The term premium to go out, say 10 years,
Yep.
has equaled about GDP growth.
Yep.
That's logical.
Yep.
So let's call it conservative 2% growth.
Yep.
So that should put the 10-year at 2.5. It's at 1.3 today.
Right.
But that's no inflation.
Right.
Add inflation to that. Let's say the Fed gets it right and is able to hold it to just 2%. That would put the 10-year at 4.5, over 3% more than today. With the current budget proposed, within a few years, that's $900 billion more in budget deficit, or roughly 4.5% more debt to GDP compounding every year. And we look like Japan or Greece, and we've got much worse problems. You could end up Argentina, end up like Greece, and very serious social consequences possibly as well. So I think I'm no better at forecasting than anybody else. I think the best way to think about these things is think about it naively. I tend to be an optimist and don't think either of the two bad outcomes is the most likely. I hope, of course, the middle scenario, but I would say, just naively, since I don't know, I'd put 1/3 in each, and you have to have a plan that at any rate can survive any of the three. So you have to balance what risks you take. You can avoid inflation risk by sitting on cash. And then if you get deflation or whatever, today you buy a 10-year TIPS, 10 years from now, you'll lose 10% of your purchasing power. That's a guarantee. And so can you make your goals with that?
Right.
Yeah, you'll have no other risk. You won't be worried about the stock market, but you will only have 90 cents on the dollar to spend. So if you want to, if you want to try to get a higher return, then you have to take some other risks as well as with some inflation risk, maybe.
So clearly, and one of the messages that we are always talking to clients about is making sure that within their plan, we're accounting for inflation, at least based on our understanding of history. And because we don't know what's going to happen. We don't have a crystal ball, as you said, and even if we did, we could get it wrong.
Not all crystal balls are clear, right?
Exactly, that's right. Then what's important is to have an investment policy that's designed to, we hope, optimally reach the outcome that clients are looking for and create a diversified portfolio that gives them exposure to many different asset classes, to hopefully arrive at that point over time that gets them the return that they need to stay ahead of inflation and taxes over time, and allow them the purchasing power that they need to achieve their long-term financial objectives.
Yeah.
what's
So
one of the things I think is important is time. Over time, we have a decent sense of the direction of things. And in the short run, we don't have a very clear idea in the short term what might happen. So I think the challenge is in the short run, less in the long run, wouldn't you say?
yeah, here's a way to think about it. So the good news with equities is over the long term, equities really represent real assets.
Mm-hmm.
And therefore, they tend to keep up with inflation and historically have provided a risk premium. But of course, we know that sometimes the risks show up,
Right.
especially in the short term. If you're a longer term investor and can stomach the volatility, equities is a good way to address inflation. However, here's the problem. Inflation comes up and the Fed tightens, and they may have to tighten a lot if inflation is bad, like Paul Volcker did, and you drive rates way up to kill inflation, and stock prices crash 30, 40, 50% maybe. And if you can't tolerate that, well, that's a problem. So you have to own less equities, and now you don't have that longer term inflation hedge. And you also have to admit there's no guarantee that equities eventually come back. For the Japanese investor, they haven't. Right. Well, that's a good reason to diversify, because we might be the next Japan. So you don't want to have all of your assets in the US. You want to diversify. On the bond side, you can avoid the risk of inflation by sitting short, but then you're earning zero, which means you're guaranteed to lose about 2% a year or more. This year, you're losing 5% in real spending power. Even though your assets didn't go down 5%, their spending ability went down 5%. So you have to then be willing to take on other risks. So I'll mention two funds that we like in client portfolios. One is Cliffwater's Middle Market Lending Fund. It makes loans to middle market companies. It's a fairly conservative fund. So the average loan to value against corporate assets is only 50 cents on the dollar. It's also almost exclusively what are called senior subordinated loans. So they're the first ones to be able to go after the asset if there's a default. So they're first in line. Everyone else is subordinated to them. Junior loans, unsubordinated debt, creditors, and of course, equity. And third, they typically only make loans where there's a big private equity firm that's providing capital, because they know that if the company gets in trouble, the private equity firm is more likely to be willing to step in and prevent the lender seizing assets, because they then get wiped out likely.
Yep. And
their history, Michael, let me just touch briefly on this for your listeners. The history of these loans is they have over 20-year track record, is they have about a 2% default rate, and because of the protections that they have, a 70% recovery rate. So the average loss over 20 years, about 60 basis points. 30% loss times 70, 60 basis points. And the current yield is over 8%. So you're talking 7 to 8% expected return, and it's all floating rate debt. So if inflation goes up, interest rates should go up with it, and you get rid of the inflation risk. So you trade it off. You now took some economic cycle risk, because in COVID, the fund dropped 3%. Now, it wasn't 30, 40% like stocks, but it did go down a bit. Your safe bonds would have gone up a little bit. But today, your safe bonds are earning 0 or 1%. And here you have 8%. You took some more economic cycle risk, but not a lot. And you got a big premium of about 7% extra expected return. The Stone Ridge's alternative lending fund has similar characteristics.
Before you go there, and I do want you to talk more about that, I just want to take a step back for our listeners and just talk a little bit more about why we consider this. And I think you alluded to it, but to put it in context a little bit more, our approach is to diversify. So we diversify first by including bonds and stocks, or fixed income and equity, because we know historically they perform differently. But in order to really diversify the portfolio, because we don't know, our crystal balls aren't clear, we want to add some additional asset classes to A, help reduce volatility in the portfolio, but B, give us a better chance of staying ahead of inflation, because we understand the performance of stocks and large companies and small companies during different periods of inflation, and bonds, different types of bonds during different periods of inflation, but we don't know what's going to happen with inflation. So it's important to include some of these other asset classes to hedge that a little bit. So I'm glad you talked about the alternative lending funds, the Cliffwater, and the Lendex is another alternative lending fund that we often use as an alternative in portfolios for the same purpose, to add that diversifier and to add a different source of return over time. So carry on.
Yeah, so let's talk a little bit more. When you said stocks and bonds perform differently, that's true, but there's a spectrum that's important for investors to understand.
Right.
Stocks and the kinds of bonds we buy in the public markets, like CDs or treasuries or AA, AAA rated municipals,
yes,
they perform very differently, because when stocks tend to do poorly, like in a recession or COVID crisis or war or something like that, you get a flight to safety. These safe bonds tend to go up in value.
correct.
Now, you could own debt that's risky, like emerging market debt, junk bonds. That looks more like equities, and especially during periods of crisis, then it looks exactly like equities.
And again,
it's a real problem.
I'm going to interrupt you because it's another great point that we often see with clients' portfolios before we start working with them. When we see sometimes the portfolios that other advisors have been putting in place for clients, especially over the last several years, and they've been continuing to take more risk in the fixed income side of their portfolios and tilting those portfolios towards junk bonds and other corporates and longer duration treasuries even. And they just don't realize, or the clients don't realize, the risk that they're taking and how they're really not getting the diversification that they should be getting from the fixed income part of their portfolio. So it's an excellent point, Larry. Thank you so much for raising that.
Yeah, let's touch on this. This is really important. So we, in our portfolios, want to own this barbell approach, if you will. Historically, we've bought risky stocks and only very safe bonds. And the reason is, in the public markets, risky bonds have not rewarded investors with a risk premium appropriate for that risk.
Right.
You've had virtually no credit premium over the long term. And while high yield bonds have outperformed treasuries, not once you adjust for risk, and also they tend to get hammered at exactly the same time that stocks are getting hammered. So the problem is, while our clients are able to rebalance, buying a lot more risky stocks that went down, because they can sell their safe bonds that went up. If you owned risky bonds, they went down as much, and you can't rebalance.
Exactly.
So their portfolio returns are much more volatile, and your downside risk is much greater. And if you run a Monte Carlo scenario, it will show you your odds of running out of money are much greater. Yep. Now, what happened really from 2008 on was a big shift in the capital markets because of the financial crisis, and the banking crisis. The banks were told by the Fed and legislatively, they messed up, they knew it, didn't have enough capital, and you are going to, shore up your balance sheet, stop lending to weak, bad credits. You can't pay dividends, no stock buybacks, and they had to raise a ton of capital. And they would discourage the lending. It actually made the recession much worse.
Right.
But what that did is it opened up to a new market that became known as a fintech market or financial technology, that private lenders came in, substituted for the banks, got rid of all their infrastructure of their big branch networks and bureaucracies, and they hired away their top credit people who ran, say, a credit card portfolio or other types of lending portfolios, and then would originate these loans and sell them into the private markets. Now, what most people don't realize, for example, if the credit card loans, even in '08, because of the high yields, made money for banks. So if you were lending in the prime area, not the kind of people who get laid off, your much higher credit scores, you made a bundle because rates were very high, and you had low default rates there. So they stepped in, and now you have all these, I'm sure your clients are aware of at least some of them, Lending Tree and SoFi and Lending Club. All these companies go out and originate loans and undercut the banks and pay off your credit card debt at 22 or 24. We'll make you the loan at 14 or 15 or whatever. And so if you know what you're doing, you can buy up those loans, okay? And when the banks originate those loans, they would take that 14% loan, securitize it. Now it's a publicly liquid security, sell it, and a mutual fund would buy it. And because it's publicly liquid and it's got a Moody's rating on it, the yield dropped 2%, roughly.
Right.
For our clients, they now have the loans originated cheaper from another source without the bureaucracy. They're going to not turn that into a liquid asset. The fund we use, Stone Ridge, buys up these loans that replace credit card, small business, the local pizza needs a new oven. And they make loans based on LIBOR, floating rate, or fixed rate, but short term. And because people want to pay off that 15% loan quickly, even though it's a 3-year loan, one, it's fully amortizing. So that means the average life would be 1.5 years, and they want to pay it off quickly. So average life of the loans are only 1 year. So in this case, you're virtually get rid of inflation risk because you're floating over something that adjusts about once a year. That we think that fund today is going to generate roughly 70 basis points or more net returns to investor. Now, did it go down during COVID? Yeah, it lost about 3%. And in '08, we think it might lose like 8%. But that's a lot better than 40% or 50 or 60 that stocks lost.
Right.
So you traded off some economic cycle risk for the risk of a big premium, about 7 or 8%. And second bonus is you got rid of the term risk of owning longer term bonds that you have to do with that. So you're getting two benefits, recognizing you're taking a little more risk. Now, if you took that allocation away from stocks, I think you got about the same expected return, 7 or 8%, but a lot less downside. But it's not tax efficient, so you only, for most people, hold it there. Now let me touch on the middle market lending. The banks have pulled out of that middle market. Companies who make 50 to 100 million or so in EBITDA or earnings, they've literally have abandoned that market. And so you have private equity players come in And Cliffwater partners with 10 different originators who have long track records of originating high quality loans. They work with one lender in each sector. So they have one who specializes, so they get to know the risk in, say, healthcare, another in technology, another in manufacturing, another in retail, whatever it might be. And then they buy tiny slivers of loans. So today the fund has about a $2 billion portfolio and it has 2,000 loans. In other words, somebody originates a $100 million loan to a company, Cliffwater steps in and says, we'll take 1 million of that 200. So they build a highly diversified portfolio. So even if one defaults, it's not a big impact on the portfolio. And they have these credit protections heavily in there. As I said, 20-year track record, estimated losses long-term, about 60 basis points a year for their index, and they're more conservative than even their index. So again, here we think 70, 80 basis points or so currently should be the expect. That's a big premium. It's equity-like, but nowhere near the downside. As we saw in April, the fund dropped, I think, 3% when stocks during COVID, March, April, were down like 35%, and some areas were down much worse. So we like, these are very different risks. You're taking, relative to stocks, you're taking less economic cycle risk, less downside risk, but you're giving up, importantly, you need to understand this, liquidity. You can only get maybe 5% is the minimum every quarter. You might be able to get more, but not if everybody wants it.
Right.
But our typical clients, even they're going to own it in their IRA because it's tax inefficient. And the RMD, or the required minimum distribution, even at age 90 is only 10%. And so you could get 20% every year. So if you're willing and accept that you don't have perfect liquidity, but also know you don't need it, you're not taking out more, you can get this big illiquidity premium. It's what the Harvards and Yales of the world have been doing for decades, recognizing they don't need all the liquidity for all their assets. We do want to keep some safe assets. Those are the ones we want to have so we can rebalance and buy those depressed stocks. But we can take some portion, either all from stocks or some from stocks and bonds, and pick up a big premium, reduce inflation risk if we took it from bonds, reduce downside risk if we took it from stocks. But if we took it from bonds, we take some more economic cycle. So we're trading different risks.
We're trading off, and thanks for going through that. I think what you've pointed out is what I think of as hopefully what the smart money is doing. Our approach to adding diversification and helping people protect their portfolios against some of these risks, including inflation. But let's talk about a couple of other things that I commonly hear people talking about as ways of protecting the portfolio or asking questions about, and that is, the old standby for some people, which is gold. Should they have gold in their portfolio? Isn't that they used to say that gold was an inflation hedge because you could always count on gold to buy a good man's suit no matter what era you were in. But is that really true? Is gold something that people should hold in their portfolio, and is it really an inflation hedge?
Yeah, so I wrote a paper on this, Michael. So if any of your clients are interested, you could forward that paper to them. Wrote it several years ago. It still holds true. So if your horizon is 100 years, gold's a good inflation hedge.
Yep.
But anyone who thinks gold is a good inflation hedge at more normal horizons, I will give you one statistics to prove, not demonstrate, but prove that that is not true. Okay. So if you bought an ounce of gold, or are unlucky enough to buy it in 1980 at the peak at that time of 850 or so,
Mhm.
23 years later, when inflation averaged 4%, gold was down under 300 and you lost 86% of your spending power.
Ouch.
23 years, a dollar would buy you 14 cents of
Mhm.
goods.
Mhm.
So it cannot be that gold is a good inflation hedge over any normal horizon. Now, gold has acted on occasion as a good hedge, as a flights to quality sometimes.
Yep.
So you get wars, things like that. Gold, you get a flight out of the dollar. You can sometimes see gold. Other times, gold does poorly.
Mhm.
Gold has done nothing for the last few years. Everyone thought it would run way up, right? Inflation's picking up. Gold has done nothing. If someone wanted to own gold and had a few percent in the portfolio, I wouldn't argue too strongly against it. But to me, there's no case for owning gold long term, because when Jesus walked the earth, gold, an ounce of gold bought you a good suit of clothes, roughly, as you pointed out. They know that from Roman centurions, what they were paid, and it bought them a good suit of clothes.
Mhm.
Today, that's about true. $1,800 to buy a nice suit of clothes, and shoes for a man. And so that's over 2,000 years earning
Right.
zero
Right.
in real spending power. Why anyone would want to own that asset, except as some insurance policy against the flight to quality. Now, here's another thing that I often hear, and sadly, this is what happens. Well, I'm worried about, social unrest, so that's what the Jews in Germany, the people in Cambodia, in Russia thought. The problem is, if that's what you're worried about, the first thing they do is come with the machine guns and take your gold. So unless your gold is somewhere outside the country and you can go get it, to me, that's not a good argument. It doesn't hold up when you look around the world, because that's the first thing that often, just ask anyone who lived through the Russian Revolution or Cambodia or in Africa, these countries, those people, horrible, the Jews in Germany, who thought they could escape and had gold with them. It just doesn't work. So I think there are far better alternatives we now have today, thanks to the changes the SEC made back about 4 years ago, which enabled these interval funds that we've talked about, which have quarterly liquidity, but daily pricing. And we're able to actually buy most of them daily, but you can get out only quarterly with notice. And that allows you to buy these less liquid assets, capture these big illiquidity premiums. And importantly, this is what's really important for your listeners to hear. This is what the Harvards and Yales, the most sophisticated investors, have been doing for decades. We're now able to invest like them, or you might think of people like Ray Dalio out of Bridgewater, the most famous hedge fund investor. He creates what he calls an all-weather portfolio. Well, his strategy is identical to what we're talking about. He may implement it slightly differently, but he's talking about adding as many different unique sources of risk, not loading up with just conventional stocks or safe bonds. Another one we didn't touch on, which is one of my favorites, not in favor recently, because like all risk assets, they go through some periods of poor performance, but reinsurance. Reinsurance has been around for 160 years. Warren Buffett, maybe the greatest investor of all time, owns a reinsurance company, and he's increasing his book, putting more risk of hurricanes and earthquakes and stuff every year. And they've been raising their premiums to reflect the greater risk. The Harvards and Yales of the world have been investing in reinsurance for decades and decades and gotten, on average, great returns. And it's all one-year contracts, so there's no inflation risk. In fact, you put in your premium today that sits in a one-year instrument. to keep it safe if it has to pay out the insurance losses. We think today the expected return is in the low double digits for a risk that has nothing to do with stocks or bonds.
Which is one of the things I really also like a lot about this asset class, Larry, and why we use it frequently in client portfolios appropriately, because the correlation to what's going on in the stock market or the economy is so low, because there's just there's no correlation there at all, really.
Yes, bear markets don't cause hurricanes or earthquakes, and generally the reverse is also true. And the argument that I don't like reinsurance because it's riskier for climate change really is a false argument, because number one, if you ask yourself, why am I worried about climate change, and list 15 different good reasons, then you have to ask yourself the next question, which people don't do, is Warren Buffett unaware of this? Are the scientists at the reinsurance company who set the premiums unaware of this? In fact, the industry has far more scientists dedicated to predicting climate and their impacts than anybody. And the impacts are much longer term effects. And so premiums adjust over time. For example, let's say somebody thinks New York City be underwater in 80 years. Well, it doesn't happen tomorrow. As we get closer, premiums, and we see the effects and the risks go up, the premiums go up until maybe you can't insure it. And you're only insuring 1 year at a time. 3
Insurance
years
companies
ago,
are pretty good at making money.
yeah. So I'll point this out. So 3 years ago, so let's say 2018, let's go back even to 2017. The insurance industry had gone through a period in 2004 and 2005 where they had 7 big hurricanes, class 3 or more, caused relatively big losses. So premiums jumped way up, 60, 70%. And then returns were massive, highest returns ever to the industry. And there were no landed hurricanes for 11 years, 06 through 17, none. So climate change doesn't happen overnight. And yet people were forecasting and it didn't happen for a bunch of reasons. Now that's somewhat luck, right? And then premiums, of course, came way down. At the end of 17, the no loss return, which nobody expects there to be no losses, was at 15%. We expected an average, and you have to think of it as a bell curve, so you know it could be better or worse, of 8% losses. So we projected at the time that fund would earn 7% a year, knowing it might lose 15 or 20 in a bad year, or maybe worse. And in a really good year, might earn 12 or 13. Can't make more than 15 because that's no losses.
Right, right.
So it had a few bad years because we had some big hurricanes. And today, the no loss return is about 22%. So if you get an expected loss of 8, let's say expected losses have jumped, now they're 10. Well, so now you got a 12% expected return. But people don't want to buy it because of the last few years. We'll see what happens. Let me point out one other thing for your clients that's really important that they are unaware of. So when the big hurricane, Andrew, I think it was, hit Miami just south of it and wiped out the town of Homestead, I think, in 93. What do you think happened, number one, to insurance premiums in South Florida?
Well, I'm sure they skyrocketed.
That's number one. Was that the only thing, do you think, that happened that would have increased or changed the risk of insurers? Or can you think of something else that might have changed?
Well,
what do you think?
I imagine that the building codes probably changed, and they're
exactly dramatically. You had to have steel and concrete, storm windows, every new building after that. So even if the same hurricane hit, right, the losses would be much lower. So premiums jumped, and the industry went on to make record profits and everyone loved it, and capital flew in until 04 and 05. You had more, and then capital left, and premiums jumped, and then and we go through these cycles just like we get with the stock market. When the stock market has no bad years and money flows in, then you get bubbles like we had in 99, and maybe now, or we don't know, you get high value. And we go through cycles. Smart investors live through those cycles because they know they're not predictable. So now let's talk very briefly about what happened. California fires had never seen losses like that ever. So it was what was called an unpriced peril. What do you think happened immediately after those big losses? What do you think happened to premiums in California?
I'm sure they skyrocketed again.
About 60% in the 2 years. So even if you could get it, prices went up 60%. Now, having gotten the other question right, what else do you think might have changed? If you want insurance in California and you're in a fire risk area, what else do you think may have happened?
Again, building codes and probably the regulatory environment changed some.
So what the insurance company said is, if you want me to insure your house, one, it's going to cost 60% more. But number two, no trees within 30 feet of the house, no two trees within 30 feet of each other, no brush in between, and extending beyond the trees, we want another 30 feet clear to brush. So there's no brush within 60 feet of the house, or no insurance. So even if you get a fire, the risks are way down. So the premiums are way up. So that's what you have to understand. And look, we know that insurance could have another bad year. And that's why we don't have 30, 40, 50% of the portfolio insurance. We may have 3 to 5%. And that's what we mean by this hyper diversification. We don't want to run away from risks. We want to diversify them.
And I think, also what you're pointing out is smartly understanding how to incorporate different risks and different ways of hedging risks within the portfolio, and creating, to use your term, hyper diversified portfolios, which has generally been our approach, applying the science and what we call evidence-based investing. And that's why we do it. We're not speculating. We're not spinning the roulette wheel. We're not polishing our crystal balls. We're relying on the evidence, and we're relying on the data to inform different factors that we're including and incorporating in the portfolio to try and manage those risks as they come along. And
let me make
one of them.
2 quick comments about reinsurance that might be helpful.
Sure.
So one, like everything else we do, like with the Cliffwater Lending Fund, which has 2,000 loans, an average loan size of only $1 million in a $2 billion fund. So that's hyper diversified, if you will. In the reinsurance, it's about 20% of it is Florida type hurricane risk.
Right.
And then you have another chunk of earthquake risk in California. You have European winter storms and Japanese typhoons and business interruption insurance, all kinds of different risks. So it's not concentrated. The other thing I'll point out there is that this is also a good inflation hedge, because one, if inflation goes up, the premiums, of course, have to go up. And when you pay your premium, the reinsurer takes it and sits on it for a year with cash, because in case they have to pay it out, and interest rates go up. So every year, right now the fund is hurting, if you will, because it's earning nothing on its cash. If inflation jumps and T-bills of 3-4%, then instead of a no loss return being 22, it would be 26. Right? So you would move up with the interest rates. And so reinsurance is another one of these that can actually help. Most people don't think of it that way, but it actually is a reasonable protector against inflation risk as well. So you're trading off some other risks. You are taking climate change risk. I agree. Maybe the climate changes faster, you get losses, but maybe the climate changes slower. than is already expected. You have to remember, we all expect it to change. It's only, will it be more or less than already expected?
And in any case, it's, again, that correlation to stock markets and the stock and bond market is minimal or nil, and that really helps with our bell curve and kind of shortening those tails, which is an important piece. Now we've run out of time, Larry, so we haven't gotten any questions, but I think to respect people's time, we're going to wrap up, and I want to thank you for a fantastic session, very educational. Thank you again, as usual, for your expertise and the generosity of your time. We really appreciate it. And I know our listeners and attendees got a lot out of today's session. And we're really looking forward to connecting with you again in the future, Larry, so we can have another one of these fantastic sessions. And thank you very much.
My pleasure, Michael. Look forward to doing it again.